What would you actually need to know to turn a serious position in XRP, XLM, HBAR, or XDC into $500 million? Not a lottery ticket, not a miracle, an actual answer. Because most people holding these assets have never sat down and done the math properly. They have a feeling, they have a thesis, they believe in the infrastructure, but they have never worked out what market caps would need to exist for their specific position size to hit that number. Whether those market caps are historically plausible and what the actual conditions are that produce that kind of re-rating. That is what this video is. Not price predictions, not hype, the actual math with the actual current numbers, building toward an actual answer for each of the four assets. And by the end, I think you're going to see your position differently than you did before you pressed play. Let me start with the framework, because without it, the math means nothing. The global crypto market cap as of right now is approximately $2.19 trillion. That is the total value of the entire crypto ecosystem combined. For context, the global equity market is somewhere above $100 trillion. The global bond market is comparable. Gold alone has a market cap of somewhere around $13 trillion. Crypto at $2.19 trillion is not small, but relative to the traditional financial infrastructure it is increasingly embedded in, it is still early in terms of penetration and the specific assets in the ISO 20202 category. The settlement layers, the payment rails, the tokenization infrastructure, those assets are even earlier in terms of their share of the total crypto market cap relative to what their eventual utility suggests they should hold. Now here is the specific question the strategy has to answer. If the total crypto market grows, and the direction of that growth is supported by every institutional development happening in 2026, from T, Roe Price's active crypto ETF, to the DTCC choosing Stellar for tokenized securities. What share of that total market do XRP, XLM, HBAR, and XDC each capture? That share question is the whole thing, because the math from there is just arithmetic. So for the $500 million question with XRP, here is what the math looks like at different position sizes. If you hold $100,000 worth of XRP today, about $88,000 XRP at today's price, what does $500 million require? It requires a 5,000 times return from today's price. That gets you to roughly $5,600 per XRP at today's circulating supply. That is a market cap of approximately $322 trillion. That is not realistic. That is bigger than the entire global economy. So the honest answer for XRP is that a $100,000 investment does not reach $500 million from a single asset alone. But here's where the strategy gets interesting. What is realistic for XRP? Let us say the global crypto market reaches $20 trillion, roughly 10 times where it is today, which would represent crypto achieving roughly 20% of gold's market cap. If XRP maintains its current share of the crypto market cap, roughly 3% at $20 trillion total, that puts XRP's market cap at $600 billion at $57 billion circulating supply. That is approximately $10.40 per XRP. A $100,000 investment today buys 88,000 XRP at $1,040. That is worth $917,000, meaningful, substantial, not $500 million. To get to $500 million with XRP from a starting point of $100,000 requires XRP to reach roughly $5,000, which requires either a crypto market of $166 trillion at current market share, not going to happen in any reasonable timeline, or XRP's market share within crypto expanding dramatically, which would require XRP to become something like 15-20% of the entire crypto market at $20 trillion total. That is not impossible, but it is a scenario that requires XRP to completely dominate the cross-border settlement layer at a scale that means every major bank on Earth is routing institutional payments through XRP ledger. The honest number for XRP is this: a $100,000 investment at today's $1.13 price. If XRP reaches its previous all-time high of $3.84, returns $340,000. If XRP reaches $10, roughly 9 times today's price, requiring a market cap of $575 billion, which is roughly what Bitcoin's market cap is today, your $100,000 becomes $880,000. To get to 1 million from 100,000 invested in XRP today requires XRP to hit approximately $12. To get to 5 million requires approximately $60. To get to 500 million from 100,000 invested in XRP requires XRP to reach $5,000. I'm telling you this plainly because the title says 500 million, and most people watching will not put 500 million into any single crypto asset. But here's what the level 99 understanding actually is. For XRP, the path to generational wealth from XRP is not about XRP hitting $5,000. It's about sizing correctly and holding through multiple cycles. If you invested $50,000 in XRP at 50 cents in 2024 before the most recent run, you bought 100,000 XRP at 384, your 50,000 became $384,000. That's a life-changing return from a reasonable starting position. The people who made transformational money from XRP were not the people who put $1,000 in and hoped for $1 million. They were the people who put in real, meaningful capital when the price was low enough that the math worked. Here is XLM's math at different scenarios. At 94 cents, a return to all-time high, a $100,000 investment today buys 500,000 XLM. At 94 cents, that becomes $470,000. Meaningful, but not transformational. From a $100,000 investment, where XLM's math gets genuinely interesting, is the scenario that connects to its specific architectural advantage. The DTCC integration goes live, and the market begins pricing XLM not as a crypto asset, but as settlement infrastructure for the U.S. securities market. DTCC processes $4.7 quadrillion in transactions annually. If the tokenized assets that begin flowing through the integration represent even a fraction of a percent of DTCC's volume, and the pricing for that role reflects what institutional settlement infrastructure is worth, rather than what a crypto asset is worth, the market cap re-rating for XLM could be significantly larger than its previous all-time high. Here's a specific scenario. If XLM's market cap grows to $100 billion, which would require roughly a 17 times increase from today's $6 billion, or a price of approximately $3.30 per XLM, a $100,000 investment today becomes $1,650,000. If XLM reaches $200 billion market cap, a price of approximately $660,000, $100,000 becomes $3,300,000. These are not all-time high scenarios. They are scenarios where XLM is priced as a settlement infrastructure asset for a tokenized securities market, rather than a speculative crypto token. The difference between those two pricing frameworks is the entire XLM thesis. If the market adopts the first framework, the math is modest. If it adopts the second, the math is transformational. HBAR's all-time high re-rate scenario, at 57 cents, a return to ATH, a $100,000 investment at 7 cents today buys $1,428,000. HBR at 57 cents, that becomes $814,000. The supply is larger than at the previous ATH. So the old ATH price with current supply means a slightly larger market cap than the previous ATH market cap. Roughly $25 billion versus today's $3 billion, which is still only an 8 times increase. Meaningful, but not transformational from a $100,000 investment. Where HBAR's math gets genuinely interesting is the scenario that connects to its specific architectural advantage. Hedera's absolute finality, the mathematical guarantee that a transaction is done irreversibly the moment consensus is reached, is the specific property that tokenized security settlement requires. Arcax has already tokenized BlackRock money market funds on Hedera. Lloyd's Banking Group has used tokenized collateral on Hedera, triggering a 49% HBR price surge when that news landed. These are not partnerships. These are live deployments producing live transaction fees paid in HBAR. The fee model is important for the math here, in a way that it isn't for XRP or XLM. Every transaction on the Hedera network requires HBAR to pay for it at a fixed dollar-denominated fee that adjusts to keep HBR costs predictable. As transaction volume grows, the demand for HBR to pay for transaction fees grows with it. That's a direct utility-driven buy pressure mechanism that doesn't depend on narrative. If Hedera's enterprise transaction volume grows by 10 times from current levels, driven by the tokenized real-world asset deployments that are already live, expanding through BlackRock MMF, most Lloyd's collateral, and whatever comes next, the fee-driven demand for HBAR grows proportionally. At 10 times current transaction-driven demand, if the market prices HBAR as utility infrastructure rather than a speculative crypto asset, a market cap of $30 to $50 billion is not an unreasonable target. At $30 billion, roughly 10 times today, HBAR is trading at approximately 68 cents. A $100,000 investment today becomes $970,000 at $50 billion. A price of approximately $1.14, $100,000 becomes $1,600,000. Significant, genuine wealth creation from a reasonable position size. But the math to $500 million from a single HBAR. Investment requires an absurdly large position or an absurdly large market cap that the current tokenomics can't realistically support. Here's XDC's math and why the small market cap matters so much for the strategy. A return to all-time high of 19 cents from today's 2.7 cents is a 7 times multiple. A $100,000 investment today buys approximately 3.7 million XDC at 19 cents. That becomes $703,000, already more interesting than XRP or XLM at equivalent investment sizes and equivalent all-time high returns, because the starting market cap is so much lower. But here is where XDC's math diverges most significantly from the other. 3. If the $10 trillion annual trade finance market begins moving meaningfully onto distributed ledger infrastructure, even 1% of it, $100 billion of annual trade finance, flowing through tokenized instruments, and XDC captures a meaningful share of that, as the ISO 2022 aligned enterprise-grade 2-second settlement network that it is. The market cap implications are genuinely different from the other 3 assets. At $5 billion market cap, roughly 9 times today, XDC trades at approximately 25 cents. A $100,000 investment becomes $900,000. At $10 billion, a price of approximately 50 cents, $100,000 becomes $1.8 million. At $20 billion market cap, a price of approximately $1, $100,000 becomes $3,700,000. The $500 million scenario for XDC from $100,000 invested requires XDC to reach approximately $1,350. That is not realistic for any reasonable market cap scenario, but, and this is the actual level 99 insight, the $500 million question is the wrong question for most people watching this video. The right question is, which of these 4 assets gives you the highest return multiple from current prices for the most realistic institutional adoption scenario? And the answer to that question, based on the current market caps and the current deployment velocity, is XDC, followed by XLM, followed by HBAR, followed by XRP. Not because XDC is the best asset, because XDC has the smallest market cap relative to the institutional use case it is building for, which means the multiple from here to a realistic institutional adoption price is larger than for any of the other three. That is the actual level 99 strategy, not picking one winner, not putting everything into the one with the best story. Understanding which assets market cap needs to reach for a specific scenario to be true, comparing that required market cap to the historical precedent for assets in similar positions, and then making a decision, and sizing your position across all four in a way that your total portfolio captures the category's growth, regardless of which specific asset the market decides to reward first. Here is the specific portfolio construction logic. If your total capital for this category is, say, $10,000, a number that many people watching this can actually commit, the level 99 allocation is not putting all 10,000 into XRP because XRP has the best name recognition, or all 10,000 into XLM because the DTCC news just moved it 40%. It is allocating across all four based on the inverse of their current market cap relative to their realistic adoption scenario. Target XDC gets the largest allocation because it has the largest potential multiple from here to a realistic institutional adoption price. XLM gets the second largest because the DTCC integration creates a re-rating scenario that starts from the smallest base relative to the size of the institution choosing it. HBR gets the third because the fee-driven demand mechanism is real, but the supply overhang has historically capped multiples. XRP gets the fourth because the institutional story is the most developed and the most priced in of the four, meaning the surprise factor, where the real multiple comes from, is smallest for XRP. That allocation logic, largest position in the asset with the largest unrealized institutional adoption gap, proportionally smaller in the asset, where most of the story is already known, is the strategy that most people in this category are not running. They are running the opposite. They put the most into XRP because XRP is the safest feeling. They put the least into XDC because XDC is the least familiar. The level 99 strategy inverts that, not because XDC is more likely to survive than XRP. XRP's track record is longer and its institutional relationships are deeper. But because the math of the multiple is better for XDC, which means for a given total position size, the portfolio's expected return from the category is higher with the inverse market cap weighting than with the conventional. Recognition weighted allocation. This strategy requires conviction in the category, in the thesis that ISO 20022 infrastructure assets are capturing real utility value in the financial system, not just in individual assets. If that category level thesis is wrong, the inverse market cap weighting makes your portfolio more exposed to the smallest, least proven asset rather than protected by the largest, most proven one. So, the level 99 strategy is not for someone who is still deciding whether this category matters. It is for someone who has already decided the category matters and is now asking how to size the positions within it to maximize the return per dollar allocated. 0 to 500 million is not a realistic outcome for most position sizes in most realistic scenarios for any of these four assets, but 0 to 1 million from a $10,000 allocation run over 3 to 5 years through a full adoption cycle with the inverse market cap weighting, with conviction in the category, with the patience to hold through the BOJ-driven carry unwinds and the Illinois transaction tax headlines and the red candle weeks. That is a scenario the math actually supports for this category. And the level 99 strategy is the one that positions for it most efficiently. Drop in the comments. Are you running a market cap weighted portfolio across these four, or are you inverse weighted? And if you've never thought about it this way before, what changes when you actually do the math for your specific position size at current prices? Because that number, what your current holdings are worth at each realistic scenario price, is the most useful thing you can calculate today. And most people have never done it. So if this gave you a framework that changes how you think about your allocation rather than just your sentiment, hit the like button. It's how this kind of actual portfolio math reaches people who are sizing positions based on name recognition rather than market cap gaps. Subscribe if you want analysis that starts from the numbers and works towards the strategy rather than starting from the hype and working backwards. And share this with whoever in your life is holding all their ISO 20022 exposure in one asset, because diversifying across the category with inverse market cap weighting is the level 99 move most people in this space have never considered. The strategy exists, the math supports it, the only question is whether you run it. Have a great day. If you enjoyed this video, don't forget to like, subscribe to the channel, and be sure to join my free Telegram community with the link on my channel where I post my daily crypto experience and arbitrage opportunities you can't get anywhere else. This is XRP Hobart signing off.